Hello traders, the title of this video is Avid Stock Trader explains passive investing. What is passive investing? Alright, so it's very important to stock traders, forex traders, technical traders, fundamental traders to understand what is passive investing or passive investor. Are you a passive investor? Are you a passive technical trader? So this is very important, okay, to all market participants, because if you are trading or you are investing, the most important thing is to trade at the correct price, the correct valuation. All right, it's very important for traders and investors. All right, so for technical traders, so we use a trading software like TC2000 and all the other trading software. But if, for instance, you have okay, a wrong data, all right, so you think that the price is now $77.72, while in fact it's at $90. That's a wrong price. So if you are looking at the chart ladder and you get the wrong price and then you trade it, you may be right, but you will lose because you are trading the wrong price. All right. The same thing applies to the investors that are buying the financial market. Sometimes the valuation is distorted. So when the valuation is distorted, you think that the financial instrument is oversold, while in fact it's overbought. Because the market is distorted, you are buying or selling at the wrong price. The worst enemy to all market participants is the wrong valuation. So what that got to do with passive investing? The passive investing create market distortion, financial market distortion, and create also wrong valuations. So it's very important for technical traders and also for fundamental traders or investors, okay, to have what I like to call a healthy market when we have the real price, the true value of the financial instrument that we are trading. But we don't want to, okay, stray away from the main topic today, all right, explaining, okay, passive investing, all right. I want to dwell a little bit more on the word passive, all right. So passive means not active or inactive, all right. Passive can also be defined as inert, okay, or in the financial market, when you hear the word passive money, passive investor, it means a dump money. D-U-M-B, dump money. Now, that's I don't like that word very much, but this word is used widely in the financial market. You may hear other financial participants talking about dump money. This is about also the passive investors' money. Also, when we are talking about passive investor, we are also talking about non-sophisticated investor. Investors that do not care at which price they are buying. So this is what I was telling traders. You want to buy a financial instrument, you are a technical trader, you want to buy, you want to sell, you need to understand that the big market players that are selling and moving the market do not buy at any price. If you are in a stock market or in a forex market or in a commodity market or in the future market and you are trading and you do not understand this basic principle that is in the financial market, that the smart money always buy at a specific price, and they do not forget, okay, the price at which they have bought the stock or sold it. All right. So you are day trader, you are swing trader, you are position trader, you are an investor. You want to buy at a specific price. All right. So that's why we traders, technical traders, use limit order. So they want to buy, they don't jump and buy straight away. They place a limit order, allowing the price to go up to fill that order. They want to sell, they use limit order so that the price goes down to fill those orders. All right. So they buy at a specific price, break below, retest, break above, retest. So those are the things that we care about, because we don't want to enter the market at the wrong time and also at the wrong place. So talking about no sophisticated market participant or no sophisticated, okay, investor. We are talking about passive investors that do not care, okay, at which price they are buying, and they do not care about market timing at all, whether the market is distorted or not. They just want to buy and they just want to sell, okay. And those are no sophisticated investors who are also passive investors. All right. So again, dwelling again on the word passive investing is also, we can say that those are not intelligent, all right, investors. But I don't like that word very much. Okay, everybody's intelligent, but my preferred word for passive investors, okay, is crazy investors. They are crazy. All right. So if you are a passive investor, all right, I don't want to call you non-sophisticated. I don't want to call you non-intelligent. I don't want to call you dumb or inert. I would like to call you crazy. Why are you crazy? Why are you doing something bad to yourself? That's what I meant. Okay, so somebody who is crazy, in this case, in this context, I'm talking about somebody who is crazy investor is somebody who is trying to hurt himself or herself. So you do not care about the time you are into the trade. You do not care whether you are buying at a correct price. You do not care whether you have a valid data. Okay, your chart is data. That's why professional traders very often have two trading software, so they compare the price. So if they see that there is a wide distortion between the two charts, they say, well, something is wrong here. There's a distortion taking place. They stop trading. They stop placing a trade. All right. If you do not care, you are a passive investor, you are a crazy investor, or all you are doing, you are trying to hurt yourself, which is very, very bad. And this is my definition of passive investor. Passive investors are crazy investors. They do not care about themselves. All right. They dumping money all over the place. That's what they call it, dump money. They throwing money all over the place into the market at the wrong time, buying at any price, at any cost, without something is $100, all right? The true value of something $100, they are prepared to buy it at $600. Are you crazy? The true value is $100, all right? And fundamentally speaking, the stock is overbought, but you still want to buy at $600. That's crazy, all right? Or something, all right, is in fact $300, all right? Okay, now it's $100. Something that is 300 in value, true value is 300, is now $100. Now you want to sell it. That's crazy. You don't sell it $100. You sell it at a true value, which is 300. So you have to understand that the definition of passive investing is more about crazy investing. You are doing things that you do not understand, and you are just all over the place doing your own thing. And not only that, you have to understand the passive investors annoy very often the hedge fund, the big financial institution. They annoy them because the hedge fund and the big financial institution that are the smartest fundamental traders do care about the true value. That's their number one tool that they are using, indicator. So when they notice that the market is distorted and people are still buying, they are annoyed. They are annoyed because the true value is no more reflected. And they notice that the market is full of a lot of sort of crazy people. And if the market is distorted, all right, or full of passive investors, all right, is saturated by passive investors, you are that is prolonged. Talking about the time it takes for a distortion, okay, to develop, you will have what we call a sharp correction. A correction that no one is expecting, a correction that is volatile, a correction that is very fast, a correction that can create havoc in the financial market, and no one wants that. All right, so this is about, okay, passive investing. So passive, non-active, inert, dumb, not sophisticated, non-intelligent, in fact, in my view, crazy investing. All right, now passive investors are investors who say, for instance, I do not care about fundamentals or true values, and most importantly, the passive investor do not care about a timing. So this is one thing I was talking about all the time to traders, is that the main difference between a technical trader and fundamental trader, somebody who calls himself or herself purest technical trader, and another person that call himself or herself, okay, purest fundamental trader, is that the purest fundamental traders, their main weakness is the market timing. They don't time the market correctly. Now, so if you put somebody who is area wave trader or Fibonacci traders or advanced technical trader, he or she can time the market correctly. So what we have noticed, the majority of passive investors are more fundamental traders. So what is happening, which I can understand, so they go around, they look at, they perform what we call Google Acid test. So the stock passes the Google Acid test with flying colors, so to speak. And you look at the valuation, they say the valuation is good, all right? And then they think that, okay, the sector is bullish, so we must buy because the fundamentals are solid and everything looks good. But the fundamentals are solid up to one point. At one point, the fundamentals will peak. So they are buying and holding shares, equities, when the fundamentals have peaked, when the fundamentals are about to go down. All right. So financial market, okay, do not go up forever. Okay, like this stock here, you can see for area wave trader, we'll say first waves. You can see here, first wave, second wave, third wave, fourth wave, and the fifth wave. And we know now we are in a corrective phase for the dollar tree. All right, this is not an invitation to buy or sell dollar tree. Okay, I need to say this video is for educational purposes only. It's nothing to do to sell or buy dollar tree. We are talking about passive investing. All right, so very, very important. So technical trader will say, okay, at this point in time, I will not buy anymore. I will wait, or I will take some of my profit, or I will secure my gain. Okay, I'll wait and see. All right, but if you are just a passive investor, non-intelligent investor, no sophisticated investor, you are, okay, in quotation, a crazy investor. This is not to insult traders, by the way. All right, a crazy investor or crazy trader, you will continue to buy anywhere, anyhow, all right, without any care for the fundamental, okay, for the fundamental analysis and also for the technical analysis. You won't care about market timing. Most passive investors will say, I just want to buy the financial market and hold. Yes, the reason why a lot of market participants, okay, are more willing to buy and hold is that over the year, buying and hold may work, but you want to time the market correctly so you do not become, okay, a passive investor. So when we are using the word passive, we are talking about inactive. So you do not want to do your due diligence. You don't want to do any verification. You don't want to know whether it's a correct, this is the true value. You don't want to know the true value of the financial instrument. You don't want to know the long-term equilibrium price level for the financial instrument that you want to buy. You don't want to know where is the market itself, all right, the S&P 500, and where are we talking about the market cycle. Where is the best time to buy? What is the best time to sell? What is the best time to hold? All right. So you don't want to do anything. You don't want. In fact, you do not care. This is what I meant by crazy investors who do not care about themselves, doing all sorts of crazy things, okay, in the financial market, and they just want to buy and hold. But in order to buy and hold, one to wait for the market to start turning, okay, from bearish to bullish. All right. This is very important after a corrective phase. All right. All right. So passive investing will distort the financial market, and the worst enemy of all market participants is a distorted market. Now, you may disagree with me today, but if you mark this video down just because I said that, all right, in the future you will realize that what I'm saying here is true. The enemy of all day traders, swing traders, position traders, medium, long-term, and short-term investors, okay, is, okay, a distorted market, and passive investing will create a financial market that is skewed. All right. Okay. Valuation will be distorted. All right. Financials will be distorted. So you look at the balance sheet, you have all this data, but they are not reflecting the true reality of the financial market. So sometimes you see trader will look at the balance sheet, all right? So they will see that, oh, they are making a lot of money. But now the question people always ask, is the money the company is making coming from their core activity? So you say you are technology stock, a technology company, but all the money that you are making is from loan that you made to other company. So the money that you are making is not coming from your core activity, though the money flow looks good, the business is not booming for you because your core activity is not loaning to other companies. So this is about a distortion and interpreting correctly the financial. The worst thing that can also happen because of passive investing is what we call financial bubble. one example of financial bubbles is the 2000 tech bubble, when the technology sector was just going up because of the passive investing, people pumping money in the market. They say the stock is going up, just buy and hold. Now, sometimes people are rewarded, especially during the third area wave. People are just rewarded because the stock just going up, everybody buy. See, I bought it last time, it just went up, I make money. This one say I bought it and went up, but because of the stage of the trend. So you buy at the right time. So you bought it, you are a passive trader, you didn't understand why the stock went up. Okay, you were just lucky and it just went up because you bought it at the right time without understanding why you should buy that time. Okay, so you keep buying. Okay, at one point you bought it, now the stocks are going down. You say, oh, now it's cheap, I should buy more. But there are more room for the stock to go down more because this is a harvest time. But you keep buying. Now, in this case, you become inactive, okay, market participant. You become non-intelligent market participant. You become non-sophisticated investor. In fact, you are becoming a bit crazy with your investing. All right? All right? So the reason why I'm recording this video today is to give a bit of warning to traders, because at one point you realize that the fundamental analysis is so important. So I'm speaking to technical traders because myself, when I start trading first, I am what I call purest technical traders. I do not care about fundamentals. And whenever I see videos on YouTube about fundamental analysis or videos about risk control, I just say no. That's not important thing. That the most important thing is to time the market. But all this together will make you a better trader or a better investor. All right. And also, if you are a fundamental trader, you say, all right, all this area wave, all this stochastic, all this multi-joint, I do not care. All right, it's all mumbo jumbo. I've done it before, and now I'm a fundamental trader. The warning to you is that technical trading will allow you to time the market more accurately. All right, more accurately. Break a ball, retest, turn around. It's going on all the time. So you do your technique, your fundamental analysis. Okay, everything looks good. But now, if you apply a bit of technical analysis, you start making better decisions. That's why hedge funds have fundamental analysts. They have technical analysts. They have okay, area wave analysts. People that know what they are talking about. So all these okay, knowledge put together will make you a more sophisticated okay, market participant. You want to buy at the right price, okay, at the correct price, at the true value. And passive investing will create distortion. So you think that the stock is oversold, but it's not oversold. Or you think that the stock okay, is overbought, but it's not overbought. But the situation that usually takes place, we see that situation during the fifth area wave or during the corrective phase, that is an expanded flat correction. So for instance, here we have for $3. By the way, this video is not an invitation to buy or sell the $3. So for instance, you are here, so this is one example of a flat correction. By the way, if you want to know more about area wave, you need to go to www.24elliotwaves YouTube channel or www.24elliotwaves.com. All right, digit 2, digit 4, Elliott waves in plural. Okay, and you are there. So the flat correction is a tricky one when you see after when the trending phase is finished. All right, the trending phase is finished, but now a correction has begun, what we call a double retracement. But then, because of the expanded flat correction, the price will form a new higher high. So now it doesn't mean that the stock will definitely come down, but this is a big warning to only those who understand the area wave pattern. So they will say, all right, the stock will display a new higher high, but now the psychological price level is the high before, okay, this one. So this is the latest high, this is the high before the last high. So if the price return back below the high before the last high, forming a flat correction, this is an invitation to sell. That's why people sold this stock. You see here, it break below this, you see where I'm moving my cursor. So this is an expanded flat correction, 1, 2, 3, 1, 2, 3, display a new high above the fifth wave. So now it's come back below the high before the last high. This is psychological price level, break below, retest. This is about timing. That bearish candlestick bar down. This is a monthly chart. They showed it there. Those are smart traders that are timing the market correctly. You'll also notice, if you are not a technical trader, that there is a trend line. You see this line that is I draw here. So this is, you see this point. You see we have the orange line, the peak line. We have a channel. Then we project that channel to the upside. We have this line here. Let's color that into green. And also, it was on the edge of a trend line. So if you are technical, if you are fundamental trader, discounting technical analysis, there is a reason why people decided to sell it exactly there. All right. So passive investing is the enemy of all market participants. So when somebody is passive, the person is in fact lazy, in quotation. All right, a little bit lazy or too lazy. All right. So there are few things you need to do, few steps that you need to do. Maybe you need to improve your understanding of the stock market. I understand first that the financial market, the market participant, the big market participant, will not buy at any price. Very important. And where they did buy before, they don't forget the price. And where they did sell it before, they don't forget that price. They tend to buy or sell at almost the same level over the year. All right, and they know the true value of the financial instrument that they are selling. If the financial instrument is at least 5 times, this is the maximum they give themselves, 5 times its true value, they are more careful to buy that financial instrument. Unless, repeat, it doesn't mean that when the stock is 5 times its true value, it's an invitation to sell. Unless they are gaining more market share, the management is more dynamic, and there are more room for growth. So, talking about the projection into the future. Though the value may be 5 times the true value today, if there's room for growth, well, they may buy it. But if a financial instrument, that's the basic, repeat, basic, 5 times its true value, but there's no room for growth, and this economy is becoming stagnant, or becoming weak, or will you buy? If you are buying in that scenario in a wrong market environment, that will be a little bit crazy in my view. All right. So this is about Avid stock trader. Explain passive investing. Passive investing is about investing in the financial market without any care to the fundamental, without any care to market timing, is that without any care to the valuations. Passive investing will create bubble, financial market bubble. Passive investing will distort the financial market. We create skewed price. All right. One should stay away for passive investing. All right, and okay, become a little bit more intelligent investors. All right. Are we now in a bubble? Okay. Is the market, the question that we can ask today, is the market full of passive investors at this stage? The S&P 500 has been going up since 2009. Is the market now full of passive investors? When the market is full, one more thing I want to say before we close this video is that when the market is full of passive investors, there are some chart patterns that usually appear. Pattern like ending diagonal, pattern like okay, price being stuck in a triangle. Very often you see a triangle giving us a warning that anything is possible. Alright, this is the end of this tutorial about Avid stock trader explains passive investing. If you have any question or suggestion, alright, please feel free to put in a comment section, and in due course I will be recording another video to answer your specific question. We are the TSTW24 traders talking about Avid stock trader explain passive investing. Happy trading to you all, and speak to you soon.